Gold just hit a record high, above $5,500 an ounce. And then it crashed. One of its steepest falls in a decade. Investors panicked. Headlines declared the gold rush over. But while ordinary investors were selling, the world's central banks were buying. Not a little. Hundreds of tons. And that is the strange part. These are the institutions that manage the reserves of entire nations. The same people who print money were quietly swapping it for metal. So why are they buying gold when everyone else is getting nervous? What do they know that you do not? Welcome to the Money Trail. Let us follow it. If this is your first time here, welcome. This channel is about one thing: connecting the dots between money, power, and the decisions that shape your world. No jargon. No agenda. Just clear research-backed analysis that tells you the story behind the money. Now let us get into it. First, the scale of what just happened. Because gold has been on a run that is hard to comprehend. At the start of 2025, an ounce of gold cost around $2,600. By the end of that year, it had gained roughly 65%, smashing through $3,000, then $4,000, for the first time ever. And then, in January of 2026, it pushed past $5,500 an ounce. For an asset that is supposed to just sit there, that is extraordinary. Gold earns no interest. It pays no dividend. It builds nothing. And yet the entire world suddenly wanted it. What was driving it? Fear, mostly. Wars in the Middle East. A grinding trade war between America and China. Currencies wobbling around the world. Every headline that made the planet feel less safe sent more money running toward gold. By the end of last year, it had set more than 50 separate record highs. Then, this year, came the correction. A sharp fall. Billions wiped from the price. Anyone who bought at the very peak watched their money shrink in a matter of weeks. Panic spread. The headlines declared the gold rush finished. And this is where the real story begins. Because the crash revealed something the boom had hidden. There are two very different buyers in the gold market. And they behave in completely opposite ways. On one side, ordinary investors. When the price soared, they piled in. When it fell, many panicked and sold. That is normal. That is human. But on the other side sits a very different kind of buyer. Patient. Enormous. And almost impossible to scare. The central banks. The institutions that manage the savings of entire nations. Every country keeps a kind of national rainy day fund. Economists call them reserves. And for decades, most of those reserves have been held in one thing above all others: the US dollar. That is what is now quietly changing. According to the World Gold Council, central banks have been buying gold at a pace not seen in modern history. For 4 years running, the world's central banks have bought around 1,000 tons of gold every single year. To put that in perspective, in the decade before, the average was closer to half that. They doubled their appetite. And kept it there. In the first 3 months of this year alone, they spent around $37 billion on gold. And here is the detail that matters most. When gold crashed this year, they did not flinch. In the first 3 months, they bought 244 tons. Then came the number that really matters. In the next 3 months, central banks bought a record 289 tons of gold. The most any single quarter has ever seen. While the price was falling, the public sold the dip. The central banks bought it. And it was not only governments. Across Asia and Europe, ordinary families rushed in too. First-time buyers queuing for coins and small bars, afraid of missing out. This is what the old market saying means by, quote, smart money. The buyers with the longest horizon, and the most information, were loading up, precisely as everyone else lost their nerve. And it is not only gold they are choosing over the dollar. In a single month this year, investors pulled nearly $9 billion out of Bitcoin funds, at the very moment central banks were adding to their gold. When real fear arrives, the world's biggest institutions still reach for the asset with 5,000 years of history, not the one with 15. So the real question is no longer whether gold is rising or falling. It is, why are the most powerful financial institutions on Earth so determined to own it? To answer that, we have to go back to one moment in 2022. When Russia invaded Ukraine, the West responded with a financial weapon. It froze around $300 billion of Russia's reserves. Money the Russian central bank believed was safely its own, locked, overnight. For every other central bank in the world, this was a wake-up call. Because it revealed an uncomfortable truth. Dollars held abroad, government bonds held in foreign accounts, are only yours, until someone decides they're not. Paper reserves can be frozen with the click of a button. Gold held inside a country's own vaults is far harder for a foreign government to freeze. And so began one of the most important slow-moving shifts in global finance. De-Dollarization. The steady, deliberate move by nations to reduce their dependence on the US dollar. According to the World Gold Council's latest survey of central banks, the largest such survey it has ever run, 74% of them expect the dollar's share of global reserves to fall over the next 5 years. 89% expect the world's gold reserves to keep rising. And a record share plan to buy more gold themselves. Look at who is leading the charge. China has added to its gold reserves for 20 months in a row, the longest unbroken run on record, while quietly reducing what it holds in US government debt. Poland and Turkey have been buying aggressively. And the group of nations known as the BRICS now hold about 17% of the world's official gold, up from 11% just a few years ago. This is not investors chasing a trend. This is sovereign strategy. Nations preparing for a different kind of world. Think about what that really means. The countries most likely to clash with Washington are the ones racing hardest to escape its currency. To them, gold is not just an investment. It is independence. And behind all of it is a number this channel has explored before. The mountain of American debt. We once asked, who will pay for America's $39 trillion debt? This is the other half of that same story. Because when a country owes that much, and keeps borrowing more, those who hold its currency begin to ask a quiet question. Will these dollars be worth as much tomorrow as they are today? The history is not reassuring. By some measures, the purchasing power of the dollar has fallen by more than 80% since the 1970s. A dollar simply does not buy what it once did. The dollar is still the world's dominant currency. Nothing has replaced it. But its grip is loosening, 1 ton of gold at a time. This is one of the oldest stories in finance. Empires rise on trust in their money, and begin to fall when that trust quietly erodes. History shows that dominant reserve currencies do not remain dominant forever. Gold, by contrast, has held its value across empires, wars, and currencies for thousands of years. It cannot be printed. It cannot be inflated away. It answers to no government. That is precisely why nervous institutions reach for it. Gold is not really a bet on getting rich. It is a bet against confidence in everything else. Now, before you rush out to buy gold bars, let us be honest about the other side. Because gold is not a magic shield. It pays you nothing to hold it. No interest. No dividend. Just the cost of keeping it safe. Money sitting in gold is money not earning anything anywhere else. Its price can be brutally volatile. This year's crash wiped out a fortune for anyone who bought at the very top. Gold has crashed before and stayed down for years. It is not a guaranteed escape. And forecasts are just that. Forecasts. Some major banks now predict gold could climb even higher, towards $6,000 an ounce. Others expect it to fall back. No one truly knows. Gold also shines brightest when people are afraid. If the world calms, if confidence in the dollar returns, its greatest advantage fades. So this is not advice to buy. It is not advice to sell. It is simply a signal worth understanding. And right now, that signal is flashing. So what does all of this actually mean for you? Follow the money, and the message becomes clear. The people with the most information about the health of the global financial system, the ones who manage the reserves of entire nations, are quietly voting with their vaults. They are trading paper promises for something solid. Quietly. Steadily. Without announcements. A vote of no confidence, cast in metal. And you do not need to buy a single gram of gold to use this. The lesson is simpler than that. Watch what the biggest players do, not what they say. That does not mean a collapse is coming tomorrow. Central banks move slowly, over decades, not headlines. But it does tell you how they are thinking. They are hedging. Preparing. Buying insurance against a world that feels less certain than it did. When the fire department quietly starts buying more water, it does not mean your house is on fire. But it might be worth asking what they can see that you cannot. So where does this leave us? Not with a prediction, but with a pattern. Watch the central banks, not the headlines. When the world's most powerful financial institutions keep swapping their own currency for gold, that is not noise. That is a message. The boom and the crash will come and go. But the quiet, relentless buying underneath is the real story. Gold does not trust promises. And right now, neither, it seems, do the people who print the money. That is the money trail behind the great gold rush. And now you have followed it. If this helped you see the signal behind the noise, hit subscribe. Because every week, we follow a new trail. And there is always another trail waiting to be uncovered. I am the Money Trail. See you next week.